In this video, we're going to look at an ascending channel. Right? Ascending channel means obviously that it's a channel. Instead of going sideways, that it's ascending. This happens to be a trade that I'm in, and I sold a call, which you'll learn a little about, later in the options course. But anyway, if you sell a call and the price goes down, you make money. If the price goes up, you usually lose money. But anyway, I'm ahead $375 on that. But that channel is ascending. Now, when I sold that call, price was here, all right? And I thought price was going to come down and stay down. As you can see here, came up here and it hit this, and it fell back down, all right? But it's in this channel. And look at these last two candles that we've got. See them here? What's that? Those are dojis. And dojis means market indecision. So that market can't make up its mind. Actually, they're little spinning tops, not dojis. But anyway, it still means market indecision. And that price doesn't have far to go to come down here and hit this trend line. All right, if it hits that trend line, it's going to bounce back up. It's got $600 to go, which is nothing for copper. Now, I'm $400 ahead roughly on that. I think what I'm going to do, because I'm worried that that price is going to come down here and hit this trend line and then bounce back up. Now, if I'd had this drawn out like I should have, but didn't earlier, when I placed that trade, I would have noticed that we had a trend line, a potential trend line coming up in here, and I didn't see that. But I might have still placed that trade because I'm ahead on it. Right? It could come back up here and bounce. It could come up here and bounce, come back down. It could stay in this trend, and I've got 40 days left on that. And every day that goes by, time decay eats it up. You're going to learn about that in the options course. Anyway, so what I think I'm going to do here, if the market's not closed, I'm going to liquidate that option. And I just liquidated that option, and I took $375 in profits on that. Okay, those are profits that are closed and can't be taken away. In other words, that's money in the bank. So anyway, like I was saying, that's money in the bank. Let's scroll up here and look at closed orders. I think that's the only order I closed today. Beans was rejected. I tried to close beans, but it was rejected because the market was closed. I'll exit that tomorrow with a profit. So the beans that I was just in, I picked up $367.50. My commissions fees on it were $7.50. So actually, I picked up $375 and had $750 expenses, so a net of $367.50 on that. So that's not bad. We were only in that trade for about 4 days. 4 or 5 days. And so anyway, that's how you would play an ascending channel. Now you could if you were doing futures, you could buy it down here, sell it up here, buy it down here, sell it up here, sell it up here, buy it back down here, if you thought that channel was going to keep going. In other words, here, when it hit this, you could have sold it, made money on the way down, gotten out here, and it turned back around. Now, this is one of the hardest things to do in trading because you don't know where all, this price action is going to take place and turn around, obviously. But just as an example, how you would do that, you would buy it and sell it when it hits the bottom and the top of the trend line. All right. Here you would sell it here, you'd buy it here, sell it here, etc., and play that channel all the way back up. Again, that's one of the hardest things that you can do trading because you don't know exactly where it's going to go. Now, do you see another channel on here? I see one here. Let me get rid of drawing tools. Hold on. All right, here I see Alright, I see this one. There's 1, 2, 3 hits. Trend coming down. Where's trend coming down from? I'd say that it hit these lows here and came down. Now remember to draw these off your charts. Alright? But there's a little ascending, or descending, I'm sorry, channel where it came down, hit the bottom, bounced up and hit the top here, came back down, tested this area here, bounced back up and hit trend on the top. So in a perfect world, you would have shorted here. You would have bought here, when you could have. Got out when it hit that. Sold it here. Tried to get out down in here. Bought it here. Tried to get out here. We're talking about a perfect world. Perfect worlds don't exist. All right, somebody that tells you they do is nuts. All right, but to give you an idea of how channels work and how you could try to play those, and where to place your stops. More importantly, I wanted to show you where to place your stops. So if you were short this market, all right, you'd want your stops up here after this trend line form. You don't know where it's going to form until after it's hit here. All right, then you'd be moving your stops down here. Be moving your stops. Now this one might have got you here, depending on how tight you kept your stops. Right, but keep your stops above that trend, and then you would have been stopped out and taken profits down in here somewhere. Now something else that we have here. Look at support here. This is kind of interesting. When it broke out of this trend here, shot up that day. Wow. Support here became resistance that day. Then it shot up and it came back down again. All right. But anyway, keep your stops on the outside of a descending channel, and if it's an ascending channel, you want to keep your protective stops below it, obviously. Okay, and trail your stops up. We're going to talk a whole lot about trailing stops as we go along in the course too. A lot of different ways to trail your stops. You don't have to just manually move them.